Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by Caliber Home Loans. At Caliber Wholesale, our products make us different, and our people make us great. Caliber Home Loans Incorporated is an industry product leader with a full offering of core conventional and government products, coupled with our innovative non-agency portfolio lending products. Contact us to learn more.
Welcome to Master of the Markets. I'm Barry Habib at MBS Highway, and this is created exclusively for Mortgage News Network, brought to you by Caliber Home Loans. They've got a jumbo alternative product, 90 LTV up to $2.5 million, 50 DTI. They'll use some alternate sources of showing credit history as well. This is a really nice program to look at to help some of your borrowers, especially those higher loan amounts. Okay, well, last week we got the jobs report, and after only creating 11,000 jobs in May, and then there were revisions lower, which actually made it like a negative net month, the June number came in like blockbusters, up 287,000 in job creations. So you kind of have to look at these numbers together, meaning that we're creating around 150,000 jobs per month. That's been about the average of the last 3 months. The unemployment rate ticked up from 4.7 to 4.9%, and the average hourly earnings went from 2.5 to 2.6%. So the bond market responded okay, didn't really love it, as you can imagine, seeing the strength in these numbers, but didn't overreact to the downside, showing you some of the underlying strength in the bond market. Now, stock market liked this number when it came out, of course, but the stock market's still pretty vulnerable at these levels. So what do we do? What's the action that we take looking into the week ahead? Well, we start off this week with kind of a slow news week, but then it does pick up with some inflation news, which is always bond market sensitive, especially on Friday with retail sales and the consumer price index that can always move the needle for the bond market. We have to proceed cautiously here. We actually were advising to lock ahead of the jobs report. That turned out to be a good strategy, but we're starting the week by floating here, going into it and watching as the information does come out day by day. It was interesting, we got last week the Fed minutes, typically been a tough release for the bond market. We've seen when the Fed minutes come out, mortgage bonds respond poorly as some of the Fed members voice concerns either about inflation or saying we should hike rates. But this was very interesting in that the Fed members now think that maybe we don't hike rates till like 2018. Now they change like the wind. They're terrible at forecasting, but the consensus and the mindset amongst the Fed, even amongst the most hawkish Fed members, is, hey, we can't go near a rate hike anytime soon. Now, after this big jobs report number, it's not going to persuade them to act for a rate hike quickly, but it will at least get them to the point of saying, let's watch the job market. Let's see if the job numbers, smoothing them out, continue to show some strength here. And then they might say, hey, perhaps December might be on the table. We're not going to see anything until December for a Fed rate hike. And even if we do get a Fed rate hike, guess what? Mortgage bonds will respond pretty well. Now, we did get some housing data last week, and look, the housing market continues to be very strong. This has got legs. Don't listen to the media that for 5 years has been wrong. We are seeing continued strength in the key areas. Supply is still tight. Demand still strong. Rents going up at a clip of 4% a year. And then this Friday, we'll see how much exactly the most recent data on rental increases in the CPI report. But when we see those pressures, yes, it has been a little, home prices have gotten more expensive, but interest rates are about 0.75% lower than where they were last year. That really compensates quite a bit. And in addition to that, earnings now going up 2.6% year over year. We've talked about this in the past. There's a relationship of about 5 to 1. Meaning if somebody's got a payment of $1,000 a month for principal and interest, their income is typically $5,000 a month. It's about normal. If you think about it, you'll see that's very typical amongst your clients. So if their payment went up, net of change in interest rate and net of home price change, by 5%, their income doesn't have to rise 5%. Their income only has to rise 1%. So long as interest rates stay the same, this 2% rise in earnings that we're seeing can support close to roughly 13% rise. 13% rise in home prices can be supported by the gains we're seeing in average earnings. Now, when we take a look additionally at the private sector earnings, they're rising much greater at 4.9%. So do we want to push the envelope? Do we want to see 10, 13, 15, 20% move higher in home prices? No. because then it really cuts it too close. If interest rates start to move up, the market can get in trouble. But the current levels that we're seeing, between 5 and 9% through most of the country, certainly appear to be sustainable. And maybe if they're tempered back a little more to between 4 and 6 or 4 and 7%, it's like Goldilocks, and you could see that for a long time into the future. And boy, oh boy, if you were to get on MBS Highway and see some of the calculators we have and then share that with your realtors and your customers, you can see how many hundreds of thousands of dollars this amounts to down the road. So the prognostication for housing, the forecast for housing, really looking good for many years to come, especially when you see the birth rates of millennials 33 years ago, which represents the median age for a first-time home buyer, looking very strong into the future. Interest rates, they're going to vacillate back and forth, but there's no reason to think with lack of inflation out there and 40% of the world's debt in negative interest rates that we're going to see a meaningful rise in mortgage rates to derail people from purchasing a home. Now, it may impact refis because they're more sensitive to rates, but on the purchase side, we should see strength based upon all the things mentioned earlier and favorable interest rate environment. All right, we'll talk next week. Get on MBS Highway. Don't be silly. Take a free trial. Buy it. You're making a lot of money right now. If you're in this business, invest it in yourself. Go ahead and help your clients and help your realtors and really put a ring around your business and kind of build that into the future. Now's the time to do it. Talk to you soon. Bye-bye.
Your reputation with your referring business partners depends largely on the lenders you recommend. This is why you'll want to choose a partner who shares your commitment to customer service. At Caliber Home Loans, our products make us different and our people make us great. A leading product innovator. In addition to our core conventional, government, and jumbo loans, we've created our own non-agency portfolio lending products. These enable you to assist creditworthy clients who can demonstrate the ability to repay. To learn more, visit us online at caliberwholesale.com.
This is Mortgage News Network.